Good afternoon, everyone. Thank you very much for dialing into the VAT webinar today. My name's Anne Holt. I'm a partner in the Indirect Taxes practice with RSM, and I'm joined today by a number of my fellow partners and directors. Hopefully you can hear us okay. For those of you that haven't met any of us before, there's some lovely pictures there on the slide for you, together with our contact details should you have any queries arising from the presentation today. We do have a Q&A functionality. If you're not familiar with the platform, please just take a moment, as they say on the airplanes, to familiarise yourself with your environment. There's a panel to the right-hand side where you can submit questions using the Q&A function at the bottom of the screen. And if your Q&A part of the section isn't showing up, then if you use the three dots icon or ellipsis icon and select Q&A, that should solve that matter for you. The agenda today, I've just put up on the slide there. First of all, Phil Munn will be talking to us about Budget 2021 and also Tax Day, which happened earlier on this week, and any key VAT developments coming from that. I know Brad Ashton, who you may have met before, our customs duty partner, will be just talking a little bit more about some of the Freeport announcements that were made during those announcements. Audrey Fearing is going to take us through recent VAT case law, Danske Bank, Wellcome Trust and the Colchester Institute. Brad and I have got the joy of looking at the early learnings from the Brexit outpourings of the last couple of months. And so we've got some diagrams and some drawings to show you. And finally, just looking ahead to the impending deadline of the 1st of April, Tom Gilbert will just be reminding us of the Making Tax Digital requirements. We'll try and take answers at the end, if that's okay today, just to make sure that we keep to time, as I'm mindful that time is precious. If we don't get through all your questions today, we will contact you outside of the seminar and provide answers to all those questions that we haven't been able to get to. Okay, if everyone's happy, and without further ado, Phil, if you can hear me okay, I'll pass over to you to talk through budget and tax key developments.
Thanks, Anne. Good afternoon, everyone. So I want to spend a few minutes today talking through the indirect tax announcements arising from the budget, but also cover off the indirect tax measures that were announced in the tax day earlier this week. Can I have the next slide, please? Great. I'll start with a run through of the tax day announcements. I think it's fair to say that there wasn't much breaking news arising from tax day for indirect taxes. Before we get to the VAT specific measures, I did want to mention that it was confirmed that VAT will be part of the notification of uncertain tax treatment regime that will come into force next April for large businesses. And there's likely to be some careful thinking done for those affected businesses in advance of those changes next year. Right, onto the VAT items from tax day. First, there was some relief that Revenue and Customs will not be amending the VAT grouping rules following responses to last year's consultation on this topic, as there were concerns about some of the unintended consequences of the grouping proposals. Having said that, there will be changes to the way that partial exemption methods and the capital goods scheme are administered by HMRC, following a recent review of this somewhat difficult area of VAT. The changes are designed to improve efficiency in the approval process for what's called a special partial exemption method. So we are hoping that it will lead to a quicker approval process for those applying for a bespoke means of calculating their recoverable VAT. The results of the review into value shifting. This is the idea of the blended VAT rate that must be applied to packages of supplies with different VAT rates applicable to them. Those changes will be announced later this year. It is hoped that this will lead to some greater certainty for organisations selling these packages, because Revenue and Customs policy in this area is somewhat confused at times. Of course, there is a risk that HMRC will apply the new rules in a manner which is designed to increase VAT receipts rather than create a fair result. Aside from a review into the manner in which certain public sector bodies reclaim VAT, the government will also conduct reviews of air passenger duty with a view to cutting duty on domestic flights, aggregates levy and landfill tax. We're also hoping to get more news later this year on the residential property developers tax, and in particular, which organisations will be affected by this tax. Right, that's it on tax day. So turning now to this year's budget, and I'll start with the headline that most of you will have read about earlier this month, and it's the Chancellor's announcement that the temporary reduced rate of 5% applicable to some leisure and hospitality businesses will be extended to the end of September this year. And that was no surprise. However, there was some good news for the sector, as it was confirmed that any suppliers subject to the 5% rate would enjoy a new reduced rate of 12.5% from 1 October 2021 all the way through to the end of March 2022. That is a surprise. It's very much a new rate, and I dare say that there will be some systems upgrades that need to be done in somewhat of a hurry. Nonetheless, welcome news, I'm sure, for a sector that has struggled over recent months. It is currently expected that these suppliers will return to the standard rate on the 1st of April 2022, unless, of course, the government responds to industry calls for a permanent reduction in the VAT rate for the industry, and that would match the VAT rate enjoyed in some EU member states. While we're on this topic, I also wanted to mention some of the VAT changes that attracted less press coverage. Some parts of the VAT penalty regime will be reformed next year in line with income tax penalty changes. This means that the somewhat unpopular default surcharge regime, along with repayment supplements, will be scrapped for VAT periods starting on or after the 1st of April 2022. A new points-based system is designed to ensure occasional slips in compliance are not penalised, but repeat offenders will continue to face penalties. And it should be noted the government is expecting to earn 155 million more revenue each year once these new measures are in place. So certainly one to keep an eye on. Just as an aside, the budget also confirmed the details of the new payment scheme for deferring VAT that was originally due between March and the end of June 2020. Originally, this VAT was not payable until the end of this month. However, taxpayers meeting certain criteria are able to capitalise on the new payment scheme and further defer this VAT if they make an application via HMRC's dedicated portal. So if you want to take advantage of the new payment scheme, it's critical that you make a clear decision on this matter quickly to avoid missing out on the benefits that the cash flow will give rise to. Finally, the decision to create 8 free ports in England later this year has been met with some excitement from those areas that have successfully applied for entry into the regime. While there are some tax and national insurance reliefs associated with these free port measures, it is clearly the customs duty and trade facilitation measures that make this announcement particularly interesting. And with that in mind, I'm pleased to hand over to Brad Ashton, our international trade partner, to go through the benefits of free ports. Brad, over to you.
Thanks very much, Phil. Yeah, as Phil indicated, the free announcement of Freeports was the first customs-related announcement that the UK government had been able to make around the customs field for more than a generation, customs having previously been under the complete discretion of the European Commission, whilst we're an EU member state. So Freeports themselves had an early briefing back in 2016 when a certain lesser-known MP called Rishi Sunak wrote a paper that indicated that by Freeports, the introduction of Freeports could result in some 80,000 plus new jobs. Whether that remains to be seen is another matter. The other interesting point about free zones is they are not Freeports. Sorry, is they're not new. They were and still are known as free zones in the EU. So the UK had 6 free zones up until 2012, when they just fell by the wayside as the legislation allowing them to be instigated was actually left to lapse by David Cameron's administration. So the name has changed, but the concepts still remain the same. Could you move on to the next slide, please? Thank you. So the ports that have been successful in being announced as free ports are on the list. There's 8 of them. They were subject to a specific bidding process, which the government was due to announce the results of round about now. But I think it was, I think timing was announced in the budget. So an interesting point to recall on Freeports is that it is a geographic location. It's not a facility that would be allowed outside of the designated area of Freeports, but an interesting point to consider in relation to the Humber Freeport, as you can see there on the 4th on the list, that encompasses 4 individual ports, being the ports of Grimsby, Hull, Immingham and Goole. So the area has a maximum spread of 27 miles. How that will be cut remains to be seen, as the legislation and the actual authorisations for the free ports are yet to be issued and are unlikely to be issued until the end of this year. So we will have further clarity there. We are waiting to see whether additional sites will be announced in relation to Scotland, Wales, Northern Ireland. Northern Ireland will be interesting to see whether the UK try and implement a free port in Northern Ireland, as it remains part of the EU single market and customs union. So that would be an interesting position, considering the UK government and the EU are currently falling out in relation to the Northern Ireland Protocol. If you could move on to the next slide, please. So the overriding benefits of a free port, the position regarding the overall economic position isn't just relating to customs and tariffs, as Phil alluded to. They are primarily designed to attract jobs into those areas, new facilities, new production facilities, distribution facilities. And whether they actually result in new jobs remains to be seen. The potential is it's just a case of the movement of roles and facilities where businesses want to take advantage of the free zone, and then they move into that area. So looking at potentially 80,000 new jobs, whether that actually comes to pass is another matter. So the overriding benefit will be that a business will have simplified access to simplified planning laws in the free zones in terms of what they can build and what they can, what businesses can actually establish in that area. The concessions around tariffs, import VAT, will come to shortly. In addition, tax breaks, corporation tax, rates, etc., are all expected to be implemented in order to attract businesses into the free zones. I guess the best analogy could be the economic zones that were set up in the 80s. Telford is one that springs to mind. It's a similar position there, but with the added benefit of creating a duty suspended area for imported goods for distribution. So it will allow facilities by location rather than by authorisations. The majority of the customs benefits available under Freeports are currently available, albeit in individual authorisations and facilities. So this will bring all of those options together in the geographic position that will be a duty suspended area, as it will be deemed not to be part of the UK economy. The second point around customs benefits is the rather grand phrase of duty inversion. Effectively, that means that if a business produces a finished good within the free zone, and should that finished good have been imported in its own right, and that would have attracted a tariff, would be tariff free, so would attract no customs duty charge, the imported components can effectively be imported duty free, processed, and then produced into the finished good with no duty charge on there. Again, That's a facility that's currently available under inward processing, but it gives businesses access to it on a geographical basis rather than by specific authorization with HMRC. One of the areas that would have potentially a wider benefit is complete duty exemption for goods that are imported into the free zone, so the free port, and subsequently re-exported. The European Commission issued a guidance paper around certain treatment of goods within the UK-EU trade agreement that went live on the 1st of January. One of the more interesting concepts around that is that if a product is imported into the UK from the EU under the trade agreement and therefore qualifies for tariff-free access, if that product is entered into the economy of the UK, into free circulation, it loses its EU status. So if the UK business subsequently distributes that product without having completed any processing on it back into the EU, that good has a liability to customs duty. In the guidance that the EU published, they have indicated that if products stay within a customs warehouse and therefore by extension a free port, then that EU originating status would be maintained, so goods would be able to be moved back into the EU on a tariff-free basis. So an interesting correlation between the introduction of free ports and a very real issue for businesses involved in the distribution of originally sourced EU goods. The final benefit will be businesses established in the free port will have access to simplified customs procedures, so import declarations and export declarations for that matter, bringing product either into or out of the UK. Businesses established in the free ports will be able to access simplified declaration processes, so the import process would be less onerous for businesses established in the free ports. So a wide range of benefits that are available on its face. We have yet to see the way the government are to implement and scope the legislation and what how businesses will be able to access space within the free ports. Obviously, those businesses that are already established within the areas of free ports will be have a head start, because they will not have to look at moving or re-establishing facilities to take advantage of this. So that's a very brief high-level outline of the concept of free ports. We will obviously flesh the details out around what it actually means when we have those details, and we'll present that in a webinar later on in the year. So with that, thank you for your time, and I'll hand over to my colleague Audrey Fearing.
Thanks, Brad. Just briefly before Audrey starts, just a reminder to people, thank you very much for submitting the questions you have so far. Please do continue to pop any questions you have online. We'll come back to those at the end. Audrey's just concerned that she didn't want you to think we were ignoring you, but we'll pick them up at the end. Audrey.
Thanks a lot, Anne. Once again, welcome to the webinar, and thanks for joining us this afternoon. I'm actually going to cover 3 cases today. So I'm going to give a quick overview in relation to Danske Bank, the Wellcome Trust, and Colchester Institute. So if we could move on to the first slide, please. So the first case I'm going to cover is Danske Bank. So this is a Court of Justice of the European Union decision, and it's, I suppose in many ways it's not unsurprising given previous case law. So the court has ruled that where a head office, which in this example was part of a Danish VAT group registration, provided IT services and support to its Swedish branch, which was registered for VAT in its own right in Sweden, then the head office and the branch should be considered as being independent from each other for VAT purposes. And on that basis, the Swedish branch should account for VAT on the IT support provided by the head office under the reverse charge in Sweden. So this decision really follows on from the earlier decision involving Scandia in 2014, when the European Court ruled that VAT was due if a branch had joined a VAT group with other local companies, as the branch was assimilated with those group companies, and the group registration created a new legal person for VAT purposes. And as a result, the branch could no longer be seen as being as indistinguishable from its head office. And therefore, in that case, when the branch was supplying services back to its HQ, each HQ had a liability to account for VAT under the reverse charge procedure. So to summarise, in the absence of VAT groups, businesses can recharge costs cross-border between head offices and branches without creating a VAT cost. This is because the branch is not economically distinguishable from its head office and therefore has no separate identity for VAT purposes. However, where a HQ is grouped with other entities or a branch is grouped with other entities, the VAT group creates a different legal person for VAT purposes, and as a result, the branch becomes distinguishable from the head office and the reverse charge will apply. So essentially what this judgment means is that this is going to impact on the VAT treatment of intercompany services provided between members of a branch network. And I think it's safe to say that there has already been some partial implementation of Scandia and the reverse Scandia principle across the EU. But additional changes, I think, as a result of this case should be expected. And I think because of this, VAT is going to increase for those businesses, that typically can't recover VAT on their costs. So financial services, insurance sector, etc. The UK's reaction to Danske is going to be complicated by the fact that this decision was delivered post-Brexit, and therefore it's not binding on the UK, albeit it does remain relevant. And the court's comments on VAT grouping's territorial limitations are also relevant. And businesses with VAT groups operating in jurisdictions that have got extraterritorial VAT group provisions, like the UK, Ireland and the Netherlands, should consider whether this judgment is likely to impact upon their existing rules. Indeed, Phil already alluded to the fact that last year HMRC and HM Treasury had a call for evidence in relation to VAT grouping. And in the tax day paperwork that came out on Wednesday, they basically announced that they weren't going to take forward any of the content of that call for evidence any further. However, Danske may cause HM Treasury and HMRC to pause a little bit and to think, actually, do we need to revisit the territorial scope of the UK VAT grouping provisions? So on that basis, we do recommend that all organisations that have kind of a branch network, an overseas branch network, that you assess the impact of the decision, particularly where you might have, VAT group registrations in other jurisdictions. So that's essentially it in relation to Danske. So maybe if we move on to the next slide, please. So the next case I'm going to cover is the Wellcome Trust. This is another European Court of Justice decision, and this was a UK referral. Essentially, this referral was asking whether VAT registered organisations like the Wellcome Trust were obliged to account for VAT via the reverse charge on the receipt of investment management services from offshore, so non-UK providers, where those services were exclusively used for the purposes of a non-business or non-economic, shall I say, non-economic activity. Because if they are, then obviously that increases the likes of the Wellcome Trust VAT costs, because it can't recover the VAT. You recall that a while ago, the Wellcome Trust lost another ECJ case in which it was held that the management of the trust and the trust assets was actually a non-economic activity. So it's been agreed, between the parties that the Wellcome Trust as a whole was a taxable person, And that was on the grounds that despite the fact that its main activities were not economic activities, it did actually have some commercial activities, so the exploitation of property rentals, catering income, etc. And as a result of that, it did have an obligation to be registered for VAT. So the question here was whether for the purposes of the place of supply rules, the Wellcome Trust was a taxable person acting as such, even though it wasn't a taxable person acting as such when looking at its investment activities. So the court has found that it was a taxable person acting as such for the purposes of the place of supply rules, on the grounds that whilst the costs related to non-economic activities, it was nonetheless a taxable person for the purposes of VAT. And the court then went on to make it clear that if a taxable person were to acquire services which for private use, so for example, it might be purchasing services to be used by its staff for private purposes, then the reverse charge would not apply. So I think whilst the decision is delivered post-Brexit, it's still going to be binding on the UK because after all, it was a UK referral. And one of the things that we would definitely recommend is that organisations who undertake non-economic activities, that they need to now assess whether they're going to be impacted by this decision. So it might be that you already registered for VAT, you incur costs that relate to your non-economic activities. Do you now need to start to account for VAT via the reverse charge? Conversely, if you're not registered for VAT and you're buying in services, from a non-UK provider, does that now mean that you should register for VAT and account for VAT under the reverse charge? So I think as a result of this case, quite a few different types of organisation will need to consider, whether or not they do have an additional VAT liability as a result of the Wellcome Trust case. Right, so the last case I want to cover is the Colchester Institute. And this one, some people might be sitting there thinking, oh, this is a bit niche, it relates to an FE college, but actually it could potentially have ramifications beyond the FE sector. And in some ways, the details of the case and the background to it are not wholly important, but I'm going to set the whole scene just so that you know exactly where the college was coming from. So essentially, Colchester Institute, further education college, providing vocational training, primarily funded by government agencies, so Department for Skills and Education, etc. But it also got tuition fees directly from students themselves, so where they were eligible to be grant funded, and it also had income from miscellaneous trading activities, So ordinarily, normal course of VAT, it would be seen as both non-business, so it's education of 16 to 19-year-olds, and business income for VAT purposes. So back in the dim and distant past, college built 2 new teaching blocks, and the works, believe it or not, were completed in 2009. And as the buildings were going to be put to a mixed business and non-business use, the college decided to apply what is now the defunct Lennox mechanism to recover VAT and costs. So basically at that time, the Lennox principle allowed a taxable person that uses goods for both business and non-business purposes to recover the VAT incurred on those costs in full on day one, and then basically to account for output tax, so impute an output tax charge in relation to the non-business use over 10 years. So it was really a cash flow benefit. Anyway, a later case, so VNLTO, clarified that Lennox should only apply to private use and should never apply to non-business activities. And because HMRC had essentially got it wrong, back in 2011, even though they changed the law, they gave organisations like Colchester Institute the opportunity to either continue to apply Lennox or to unravel their previous activities. And in the case of Colchester, they'd recovered 2 million of VAT incurred on the building, less the output tax that they paid on deemed supply. So they decided to just carry on as they were. Then in 2014, the college took advice and they revised that actually, the provision of education to your students, we actually think it's all business. We don't think any of it's non-business at all, irrespective of how it's funded. We think it's all an exempt business activity. And the college was basically sought to argue that the grant income it got from the likes of the Department for Skills and Education, that was consideration for the college's supply of education. And so what it did, it submitted a vol deck to HMRC to recover output tax of 1.5 million that it believed it had overpaid under Lenart's because it didn't have an obligation to, because it didn't have any non-business use of the assets. But at the same time, because it was outside the 4-year time limits in relation to the input tax it originally claimed, it only had to repay circa 138k's worth of input VAT. Not unsurprisingly, HMRC refused the claim. They basically held the view that education that was grant funded was non-business and non-economic activity, and that resulted in the college's appeal. And the first tier tribunal actually ruled in HMRC's favour. They basically said, no, it is a non-business activity, just carry on as you are. But the upper tribunal has reached a different conclusion. And it's found partly in favour of the college, and this is the cruncher, this is the bit that's really important, because it held that actually it agreed with the college that the education of 16 to 19-year-olds was a business activity. And the rationale for that being was that when it looked at the funding and how the funding was calculated, there was a clear nexus between the value of the funding received and the delivery of the education to be provided to the students. There was a clear and direct link because the funding was all predicated on a cost per course multiplied by the number of students. And if students dropped out or they didn't teach as many students as they were expecting, then they actually had to repay part of the funding. So they held that there was a direct link between the income that they got from the third-party funder and the education of the individuals concerned. And therefore they felt that that was consideration for supply and it was consideration for an exempt supply. So what does that mean? Obviously for Colchester, it meant that they were right. They didn't have to account for the output tax via the Lenart's mechanism. But the court then went on to say, but hang on a minute, is it really right that HMRC should be time barred in relation to recovering input tax? And what they held was that both errors were a result of the same mistake, the incorrect application of the Lenart's principle. And therefore, on that basis, HMRC weren't time barred. So in many ways, it was kind of a Pyrrhic victory for Colchester. Albeit that I think they stopped paying some of the imputed output tax, so maybe they did have a little bit of a windfall. But the wider implications of this case go beyond FE colleges. So for FE colleges itself, they will now have to really look at quite closely, do they qualify for relief such as relevant charitable purpose building relief? Because they're now no longer using them for a non-business purpose, they're going to be using them for an exempt business purpose. And could that jeopardise the eligibility for that relief in relation to buildings that they've constructed in the last 10 years? It also has an impact on other bodies, other centrally funded bodies, for example, hospices, organisations whose activities might be subsidised via funding from other parties, because does that now bring that income into the VAT net? So organisations that are funded from central government departments or from other bodies, we need to look closely. Is there a nexus between the income I get from the third parties and the supplies that I mean? And does that now mean that what was historically treated as a non-business activity is now an economic activity for VAT purposes? So it's not just FE colleges that this case will impact. It can impact a whole range of other organisations and result in potentially quite useful reliefs being lost to those. So we'd really recommend that, if there are any FE colleges listening or any organisations that get either funding from government or third-party funding, that you actually look at your VAT treatment in relation to those and determine whether or not non-business treatment is still the right treatment. So that's everything from me. Hope that was useful. And I'm now going to hand over to Anne and Brad in relation to Brexit.
Thanks, Audrey. There's not an easy segue from availability of charitable reliefs and input tax recovery into Brexit and early teething problems, so I'm not even going to try. but we might just take a pause for a moment to allow your brains to assimilate what Audrey has just said before moving on to the next equally complex and challenging topic of the current moment. Okay, so if we just have a look, the purpose of this session, we're not going to focus on any particular legislative changes or case law changes. What I was trying to do when putting together the next few slides was just to give an idea of some of the structures and trading structures that are causing some challenge for people involved in the movement of goods right now in the immediate aftermath of Brexit. Some of them are predominantly VAT challenges, but I've asked Brad to join me on this session because actually there are also some customs duty points as well, which arise from this too. Sometimes this is resulting in goods getting stuck in port. Sometimes it's just actually the building up of latent tax exposure, which may well come out later on as tax authorities start to wake up to what people have been trying to do in an effort to navigate the complexities of Brexit. So the first case that we look at involves what would have previously been known as a dropship, if people are familiar with this, or a direct ship method. And this is where we've got three parties involved in a chain supply, A selling to B, B selling to C, but actually for point of ease or possibly goods availability, the goods moving directly from the first party in the chain A to the last party in the chain C. Now that grey bar that appears across the bottom there, you'll see that on a couple of my diagrams, that represents the customs border that now exists between Great Britain and the rest of the European Union, so the rest of the European Union, and that prior to the 31st of December, that grey bar would not have been there. And a majority of businesses involved in this sort of structure prior to Brexit Day would have treated this transaction as a triangulation where A, B and C may have VAT registrations from the 3 different member states. Triangulation is no longer available where one of those parties is not able to provide a European VAT number, as would be in this case because we've got C based here, the wrong side of the border in the UK. So what has started to come about as a result, probably February and March time, these queries started coming in as people started to try and move goods in this way. Firstly, a lack of clarity from A's perspective as to what they needed to put on the commercial invoice for the export, because of course they're not necessarily the exporter in this case. If they're selling to B, it's possible that B might be the exporter. If A is the exporter, then there's an issue, Brad, I think it's fair to say, for valuation on that point, because the valuation for the export would be the sale from B to C, maybe.
Yeah, absolutely. And I think that this is a good example of where supply chains that have worked for forever in relation to the single market suddenly become unfit for purpose. So, and this is based on a real life example where in this scenario, company A sold goods to B, but under their contract sale, they sold those goods on DDP terms. So whilst the sale was to B and B subsequently sold to C, A was contracted to provide the goods on a delivered basis to C. Now, under the triangulation provisions, whether it was right or wrong is another matter. That's history now. But post-Brexit, with the UK leaving the single market and the customs union, a DDP term in this scenario is unsuitable, primarily because if goods are moved from A directly to C under transit procedures, or when, depending on the timing of the sale, where the customs declaration is being presented by A to the customs authority in C's territory, they do not and cannot comply with the customs valuation law, in the EU, because that legislation requires the value of the sale taking place immediately prior to importation is the value for customs duty purposes, which in this scenario is the sale between B and C, which A doesn't have visibility of. So therefore, in this scenario, A have had to reconsider their contractual obligation to B in terms of delivering the goods, and they've now moved to an FCA term, which makes this process work from a customs duty perspective.
So from a VAT perspective, the issue is identifying where title is passing between A and B, and then also between B and C, and what the terms of trade are with respect to both of those contracts, because that will drive who has responsibility for the goods when, and who has responsibility for making the declarations to the customs authorities in the country of arrival. So the potential situation is actually that if A is selling to B on X works basis, B has a responsibility possibly to register for VAT in A's member state and then export the goods to C. And then, as Brad has said, depending upon the customs trade terms, will depend upon whether B is importer or indeed C is importer. But it will be the terms of trade potentially of the sale from B to C that will drive that.
So sorry, one thing I forgot to say was that in that scenario with the business moving to FCA, C has become the importer.
Yeah. But it requires an understanding of the terms of trade and redrafting of the same, all of which at the moment in a post-Brexit world we are playing a little catch up and dealing with that in real time. Dealing with real time, I think we probably should move on to the next scenario. So again, here we have a supplier who previously would have put goods on the back of a lorry and popped them through the Channel Tunnel going one way or the other, or on the back of a ferry, and taken them directly to his customer's premises. He wouldn't necessarily have considered exactly what his terms of trade were. There was no customs border in between. The customer would have provided a local VAT number in the country of receipt, and the supplier would therefore have treated it as outside of his local scope of VAT, and the customer would have accounted for acquisition tax. With the importation of the border there between the two parties now in a post-Brexit environment, potentially if the terms are DDP, as Brad has already mentioned, the supplier is responsible for declaring the goods to the importation customs authority and will require a local VAT number to complete the sale in the country of arrival to the customer. So we're suddenly seeing an influx of a number of overseas companies right now registering for VAT in the UK where they're selling goods on DDP terms. There is no VAT registration threshold in the UK for a non-established overseas supplier. So that is a first sale principle for VAT registration. And that's the same if you look the other way. So if the supplier is in the UK selling goods into France on DDP terms, then the supplier will be potentially responsible for registering for VAT in France on that basis. And the potential solution, Brad, here I think is possibly on the right-hand side, which is what we call regime or procedure 42.
Yeah, in relation to inserting a tax representative, not a fiscal representative from a VAT perspective, but a tax representative who effectively loans a VAT registration number granted specifically for this purpose to the importer. So it allows the importer to make an import declaration in its own name, quote the tax representative's VAT registration, which allows them both to avail of the regime 42 or onward supply relief, so import VAT isn't paid, and also facilitates the necessary subsequent intra-community movement of those goods from the member state of import to another member state, where the ultimate customer accounts for VAT at the rate in their own territory. So effectively, it facilitates the importation of goods by a non-established business without necessitating a VAT registration in the country of import, and an EORI number for the EU in this scenario would still be required.
So the only thing to bear in mind with that diagram on the right hand side there is it won't work if the customer is present in the country of importation. It only works where the customer is present in another member state. So in the scenarios we've seen most recently, that's been an importation into Belgium, the Netherlands or France for onward supply to somewhere such as Germany. But it gives the same look and feel to the DDP terms as would have been the case in a pre-Brexit environment, but it requires the involvement of the limited tax rep. Moving on to the third most common challenge and problem we've got, we have here a supplier who has already made supplies of goods to his customers in a number of countries outside of his own, and those customers have either got a need to return those goods because they're no longer required, or they might be goods which need to come back for repair or adjustment as a result, and then obviously either be replaced or have repaired goods sent back to the customer. Each time those goods pass that customs border, some form of declaration has to be made by someone. Quite often is the case that in fact suppliers are unwilling to place that burden onto their customers because they want to be in a position to provide good, seamless customer service. And in those cases, quite often we're finding the answer to those questions is to have a site the other side of the border for the supplier where they can at least collate and sift those goods which they do want to return back to the originating country for repair and process. But here, Brad, we're looking at inward processing and outward processing relief, I guess.
Yeah, very much so. The dynamics around the movement of goods crossing borders on numerous occasions has long been a talking point around Brexit, but the actual physical movement of goods would necessitate the mitigation of duty and suspension of import VAT liabilities, depending upon the scenario. So where a business may be returning an item for either repair or production from, say, the EU into the UK, the UK operator would be looking at inward processing, as Anne mentioned, in order to mitigate the duty liability. Import VAT liabilities are also suspended on that, conditional on the re-exportation of the goods, and the customer could operate outward processing for their movement of the goods, which would mean that any duty or import VAT liability would be restricted to the cost of repair and or processing. So the intrinsic value of the item will be excluded from any return import taxes liabilities that the customer may have.
And from a VAT perspective, the key challenge here is the import VAT, which is otherwise chargeable in the absence of a processing relief on the movement of somebody's goods into the country. So the supplier not owning those goods any longer would not be able to recover that import VAT into his own country prior to repair. So there's a potential VAT cost otherwise that can arise in that supply chain. And finally, just one that's becoming more prevalent actually in the last couple of weeks, which is where we've got a company one side of the border buying goods from suppliers the other side of the border to have processed in that other location. We're finding that actually, because those goods are not physically moving to the customer's country across the border, that is generating at least one, if not two, VAT registration obligations for the customer in this case. And we again are looking at ways in which we can mitigate that at present with a number of clients. But if you've got this sort of structure in your business and you haven't yet got round to looking at it, there is a risk that there is actually a VAT registration obligation in the country of the processor if you are owning the goods whilst he's processing them. Brad, I don't know if there are any particular comments on that one.
No, I think again that is an issue, certainly as far as UK businesses are concerned. That is an issue that is slipping between the cracks. The consequences of a again, going back to the triangulation approach that we discussed, a supply chain that was more than fit for purpose before the end of the transition period now presents other issues, and primarily for toll processors, general processors and repair operations, that non-ownership of the goods creates potentially a 20% additional tax in regard to sticking import VAT. That things like mitigation opportunities like in wood processing actually removes.
Yep. Thanks, Brad, for that. I think that brings us to the end of our Brexit session. Tom, are you able to pick up on making tax digital?
Yeah, great. Thanks, guys. So I just wanted to provide a quick update on making tax digital with the digital links off landing period ending very shortly. So I wanted to cover a few common myths as well as some of the common issues and pitfalls that people are seeing in practice at the moment. So the first thing to note is that this applies to your first VAT return starting on or after the 1st of April 2021. So if you are on standard calendar quarters, this really means that you need digital links in place in July when you're pulling your VAT return together. So you might have a bit more time than you first thought. However, I would encourage you to make sure that you are compliant now in case you do need to make any changes such as IT changes that can take a little bit of time. Looking at the myths and misunderstandings, sometimes people think that the process has to be fully automated and self-contained in your accounting system, and this is not the case. You can continue to use Excel, and the reality is that an accounting system really is not designed to be a dedicated VAT reporting tool, and often there isn't the flexibility in the accounting system to perform tasks like making adjustments, which are often required. Saying this, some larger businesses are starting to implement dedicated VAT reporting tools. In terms of making manual adjustments, you can still make these. However, you just need to ensure that you do this in the correct way. And likewise, you can still continue to use a bridging solution as you can still continue to use Excel. And another point, crucially, HMRC are not able to see into your systems. You will still be submitting the same non-box VAT return numbers that you were submitting previously. The only difference is that the digital links now must be in place. In terms of common issues that we've come across when reviewing VAT return processes, the use of copy and paste is pretty common, and copy and paste is specifically prohibited by HMRC as it breaks the digital links. However, there are other Excel functions that can help achieve a similar outcome. And another point, sometimes VAT returns are calculated more on an accounting basis by using GL codes. So looking at the input and output VAT values in the GL and then recalculating the net figures on this basis, which breaks the digital links for the net value. So that's something that we do see quite often. Another point there, manually typing in numbers is just not allowed anymore. Thinking about expenses and treating disallowable expenses correctly, that's a fairly common limitation in the setup of some expense systems that we see that does break the digital record keeping requirement. I guess another point, the treatment of overseas transactions can get a bit complicated, and again is something that we see quite often coming up as an error. A good example of this is something like Microsoft Office subscriptions that most people have that can be invoiced from Ireland and should be treated as a reverse charge transaction, which is quite often treated incorrectly. And the treatment of postponed VAT accounting and imports is also important to get right going forwards. So that was a pretty quick run through of some of the issues and challenges that can occur when you're starting to look into the details around digital links. So thank you very much for listening today, and I'd like to open the session up to any questions.
Thanks, Tom. We've had quite a few questions as we've been going on today. I wondered, Phil, if you might be able to just answer those few questions on the system VAT deferral scheme and also the relevant deadline.
Okay, hey everyone. So I've got a question. So keeping the all the questions anonymous. The one that I can see here in front of me, I'm afraid I don't have access to all of the Q&A function.
Oh, okay.
But I can see there's a question on early termination fees, which I can answer very quickly, because Revenue and Customs updated the reference. So there's a Revenue Customs brief that was issued last year, stating that their policy on early termination fees was changing, and it was going from outside the scope to taxable. The question is, when will that brief become mandatory? Because it's clear that following the issue of that brief, Revenue and Customs had some pushback on the scope of the changes. I'm afraid we don't have a date yet for when that will become mandatory, but what I can tell you is that as matters stand, it is possible to continue to treat these supplies in the same manner as they were treated prior to that brief being issued. It had been expected to change some weeks ago now, but to date, I don't think I know, or there is no sign on Revenue and Customs website at least, that that's going to, there's a particular date when that will become mandatory. Sorry,
Okay.
Anne, is there another one that I've missed?
No, it's all right, Phil, don't worry. So Ben's asked a question here with regarding to deferred COVID payments. He says his understanding was that he did not have to apply for deferred COVID VAT payments until June unless we wanted to take advantage of the 11 instalment payments. You seem to indicate in your presentation that you need to make a quick decision, i.e. would need to apply before the 31st of March. Can you help us which deadline it is, March or June?
So yes, it is. There is a June deadline, but as Ben has rightly said, by deferring the decision until later, the options available to you in terms of those deferral payments narrows a little bit, and you get fewer instalment payments. But it is possible to defer until June.
Okay.
So is that the question?
Yes,
hopefully
thank you.
I got it. Fantastic.
And Toby's asked a related question, and it'll be interesting to see if you've heard this too. He said, regarding the VAT deferral scheme, I've heard that there's a large problem with applying if you have a VAT return with an outstanding, even if current one, a VAT return outstanding, even if it's a current VAT return which is outstanding. Is there any update on this being fixed?
I know that Revenue and Customs have set a series of criteria which I mentioned earlier on, and they wouldn't be settling or agreeing a new payment scheme until all of your VAT affairs are up to date. I appreciate that in some cases that might be an error on Revenue and Customs' part. I'm afraid I don't have, I don't have any particular items on that, except to say that, of course, it's worth getting in contact with Revenue and Customs as soon as possible. And of course, we shouldn't forget that it might be possible to apply for a time to pay arrangement if the new payment scheme, for whatever reason, isn't the right answer for your particular business. But of course, there's a separate mechanism for time to pay arrangements.
Thanks, Phil. That's great. I'm just going to squeeze one last question in at this moment and before we finish today, because it's an important one. Doral has asked, following Brexit, are we still required to apply reverse charge for services to a EU company, or is this now considered outside the scope of UK VAT? So just to confirm, in respect of the VAT treatment for supplies of services between the UK and the EU, largely that has remained unchanged. So if you are receiving services in the UK from an EU supplier, typically you're still required to undertake a reverse charge in the UK and vice versa. There are small limited exceptions, and particularly there's the increased capacity for use and enjoyment overrides to apply particularly to letting on hire of goods and telecom services. But so there hasn't been any fundamental change to the VAT accounting for VAT on services as a result of Brexit. Okay, so with that in mind, it's now 3 o'clock. That probably brings us to the end of our time today. Thank you very much for joining. You see Phil is actually also in charge of RSM's VAT group. If you haven't become a member of that yet, I encourage you to do so by following the link on your feed, and you'll get our latest updates from there. And please also do give us some details of your preferences for what you would like to hear from us in respect of other matters. We will take those on board, but if you can follow those links, I'm afraid following GDPR, it's very much self-select. Thank you very much for making the time today. We will address any other questions via email, but for now I wish you a great afternoon. Thank you.